follow very closely in this business, and it sounds a little nerdy, but right now it's registering its lowest reading since 1993. Now, technically, a lot of people look at that and say, well, if there's very little fear out there, that can't be a good thing, because it's counterintuitive in that when there's very little fear, then obviously people are too complacent, too happy, and the market's going to go to hell in a handbasket. So this phenomenon is something we follow closely because people bet money on that, and that fear gauge is such that people don't seem to be worried, and that is tempting in a lot of investors. You've seen it and heard it maybe among your friends and colleagues who rush into the market and think nothing of it. And a lot of the pros, I tell you, including Sam Zell, who will be my special guest on 4 p.m. on Your World on Fox News Channel, that sometimes the crowd is missing something. And when the crowd is all going one way, of course, Sam Zell famously goes the other. So I wonder what he makes of that. But ahead of that, to Market Watch's Craig Smith and Heather Zumarraga. Now, Heather, you're looking at this, seeing this, and saying what? Not to worry, or what?
Well, as you stated, Neil, the VIX, the fear indicator, so to speak, is usually a bullish sign when it's at all-time lows. That there's not a lot of volatility and panic in the marketplace right now. But I actually am going to take the opposite stance here, because it's at all-time lows, but we've had an amazing week of all of these macro events, from policy out of Washington to French elections, a great jobs report. So for volatility to be this low, it's almost a little bit eerie. Right, the calm before the storm.
Yeah, you know, and it depends on when you place it. I mean, 1993, if you think about that, Craig, was right when Bill Clinton was taking over, and there were Dow forecasts for the Dow, and then we know what happened after that. It took some years here, but it could be presaging continued good times, or it could be presaging the opposite. Where are you on this?
Well, I got to tell you, I'm kind of along the lines of what you've heard on Fox Business most of the morning, and that is, it's terrific that it's happening, but we better be careful. I love how you incorporate
Fox Business into how you discuss things. And
it's the best business channel in America. You've proven it's the best business channel in the world, so it's the only one to follow.
Really?
The reality is, Neil, that I see a cognitive dissonance out there right now. I mean, think about this, Neil. We had 0.7% GDP. We have a lack of productivity. We have basically full employment. We have allowed low interest rates to distort the markets dramatically. And so I tend to agree with Heather. I wouldn't be so complacent here right now and just assume that everything's going to be great, because think about what happens to companies when they miss earnings. I mean, quarterly earnings come out.
But they haven't, right? I mean, about 3/4 of them are beating those estimates, right? So maybe this number is justified.
Earnings are up 13% year over year, roughly, in the S&P 500 across the board. But then why is GDP at 0.7%, as Craig is alluding to? It doesn't make sense, although the Federal Reserve has come out and said this may be transitory, there will be revisions, the GDP data growth may pick up in the economy. That's still a very anemic number to have full employment, no volatility, and stock market near all-time highs. You hope it's not all predicated on the Fed and low earnings expectations.
All right, guys.
Neil, think about that. Think about what Heather just said, and it's so important. I mean, we are seeing earnings up 13%, and again, taking out the outliers like, Under Armour, who missed and went down 22% one day. But you have a stock market that has literally tripled since the lows of 2008, yet we've had below 2% growth. Now, how do you justify a stock market that's tripled when you haven't had growth to compensate for that?
Maybe because it's factoring in. Maybe because it's factoring in growth with tax cuts and all. You're not buying that, right, Heather? Or?
I don't buy that. I think you're.
Okay.
Yeah, I hope so. It's all predicated on expectations, but the Fed, I think, has helped prop this market up with low interest rates. So easy money is going to flock to the stock market and risk assets because there's nowhere else to put your money, Neil.
Okay.
Absolutely. People are chasing return, Neil, and the only place you could go is a stock market. And that's just not American investors. That's the world.
All right.
And Fox Business.
There you go. Now, you're both invited back. It's brilliant as you are. Thank you, guys, very, very much. Again, this is not a hard and fast rule. I only throw that out you there because it's